U.S. stocks wobbling at the open. This week, we'll have one big earnings report, the Nvidia release. Let's get more from John Zechner, chairman and founder at Zechner Associates. John, thanks very much indeed for joining us. What do you think? Is there a smell of fear in the air over the AI stocks and whether they've gone too far?
Well, there is, Andy, and I mean, it's interesting. I mean, you're knocking out sort of two of the pegs that have kept the bullish argument going for the AI stocks for a while. The first one being the depreciation schedule. People are suddenly worried about. It was brought up last week, like this, all this equipment that's being put in, and the growth. Um, has suddenly using like 6 to 8 year depreciation schedules, and what if because of obsolescence and the need to upgrade more
Mm.
quickly, what if the useful life is more in the 4 to 6 year period? These companies are not depreciating the assets enough at a quick enough rate, and if they're not taking enough depreciation, you're overstating your earnings. And let's face it, earnings have been one of the great sort of backstops of the growth story of technology overall. When people say, well, it's different than 2000s because the earnings are better. Well, if not, not if the earnings are overstated. And
Mm.
then the other thing is, well, people might say, okay, well, earnings don't really matter. It's cash flow that matters. Like, that's just an accounting entry, depreciation effectively. It doesn't impact cash flow. Absolutely true. But what we've noticed is, and again, a second argument is that the free cash flow. The free cash flow was a great argument for these big tech companies for a year. They generate gobs and gobs of free cash flow. They were like banks. They were like large governments or anything in terms of the cash balances they had. They could buy back stock. They could do acquisitions. But now, what we're finding is they're moving into a negative free cash flow, and after getting financing elsewhere, including the bond market. You saw, Meta's deal for 30 billion in bonds.
Mhm.
Alphabet has come in. Obviously, OpenIA is
Mhm.
doing a major raise, even though they're not a public company yet. So people are so. The second argument that they've got this great free cash flow, that's not true. So then you start to worry about, okay, when you start to monetize AI, maybe there's a bit more of a rush to monetize this AI, because if these companies are, like I say, overstating earnings, and if they're not generating free cash flow, this story better start generating some profit in a hurry. So, we get the bar set a little bit this week with Nvidia. I don't expect a miss, Andy. I mean, these
Mhm.
guys have knocked the ball out of the park over the last 2.5 years. I remember back in early 23 when that first quarter, I think they were expected 9 billion in revenue, and they hit almost 11. And now you're looking at 54 billion, I think, the expectation for a quarter. So we know they get the lion's share, but we saw good earnings from some of these tech companies that did not turn into great stock performance. Look at Palantir, Microsoft, Meta. So the bar is set very high, and can they beat that? And what are the sales to China, and how far fast are they rolling over the equipment? So you know what? Everybody's in the story. People love it. It's maybe a little bit overhyped, and some things coming up from the woodwork lately are a little bit reminiscent, I hate to say it, of
Mhm.
the 2000 when you overbuilt telecom, and you had a different valuations model. Maybe it's better today, but maybe not that much better.
And apparently, Peter Thiel, who knows a thing or two about tech investing, his hedge fund sold off its holdings in Nvidia in the third quarter. It's now betting on Apple, Microsoft, and a reduced stake in Tesla. But interesting, so we get the Nvidia numbers on Wednesday, as you know, after the close. Maybe you could put up a 1 year chart. Interesting, a smart player like that backing away from Nvidia.
Well, everyone's made a lot of money on these stocks, Andy,
Yeah.
as you point out, and they're shifting maybe to safer bets. I mean, obviously, you
Hmm.
saw the thing on Berkshire Hathaway taking a stake in Alphabet as well, which Alphabet, Meta stick out to me as more value-oriented plays in the sector. These guys will probably monetize AI sooner and better than anybody else, because
Hmm.
they can deliver to their clients through their apps or through their public clouds, which Google have, the benefits of AI more quickly, and they can they can sort of benefit from that, and sort of monetize it more quickly. So you can see people shifting to that and away from these high flyers that have no earnings, and you don't exactly know what the valuation is going to be. So we've reduced our bet overall in the sector, Andy. I mean, we're always going to be in technology. It's still a great growth
Hmm.
sector, but right now, in terms of what we're adding in the portfolio, I'm looking more some of the beaten up areas, some of the tax loss selling candidates where I think you're creating a bit of opportunity if you've got a little bit of of patience to ride these things through, because as you know, I mean, the one thing is sometimes good earnings are met with selling, but bad earnings have been absolutely decimated. And I think that's creating some opportunities out there.
One stock that you got your eye on is Northland Power. They just slashed the distribution. The stock tanked. Is that one you say shows potential?
Oh, absolutely. That's a
NPI, sorry.
classic. Yeah, NPI. That's a classic example of it. Yeah, trading now about 7 to 8 times forward cash flow, which is great for renewables. I mean, renewables are out of favor, and that dividend cut. Yeah, there's a lot of dividend investors out there, and that 27% sell off or whatever it was the other day just wiped out the year's gains that had been actually a pretty good performer. But I was on the conference call, and when you listen to what management was saying about why they missed it, it's really because they're seeing more of opportunities available to them. I mean, there are two major projects, Halong Bay and then North Baltic, are coming along just fine. I mean, they're going to put them into production over the next year and a half or so, generating cash flow. And what they're seeing is more opportunities because, with what's going on with the U.S. administration and they're sort of way that move away from renewables. I mean, it's creating some opportunities for others with capital. But I mean, cutting a dividend is not the way to do it. And no, I've seen it a few. I mean, another name we're buying in here is Cargojet recently.
Okay.
Again, a bit of a disappointment on the numbers, is economically sensitive, but the stock got absolutely decimated. It usually trades at 10 to 15 times operating cash. So now it's down to 6 to 7 times. And then I noticed the founder came in last week and he spent $1 million buying stock himself, which I always love it when I see the founder, one of the original principals in there buying stock. So things like that. I mean, you got to have a little patience. Sometimes it's hard buying the dogs like that. I mean, but maybe it's just me. I'm a marathon runner, and I'm used to pain. Maybe that's it.
BCE, our parent company, you see potential there?
Another example, exactly, Andy, of that valuation. They cut the dividend. Everybody's come out of the stock. They dislike it. But look at the valuation of the tech or the telecom sector in general. I find it very attractive, and everyone's sort of poo-pooing the idea of what they're doing with Ziply and what they're doing with fiber in the U.S. I mean, BCE knows fiber well. I mean, they've done a great fiber build out in Canada, and all they're doing is levering that expertise a little bit into regions of the U.S. And I think it's a smart way to continue to grow within the telecom business. They've monetized some assets recently. They've sort of cut, obviously, cutting the dividend, improved their cash flows a little bit. And then when I look at the long-term valuations of all of these players, I think, I don't see much downside. I see a dividend yield protection a little bit, and I see some upside if investors come around to it a little. So I think sometimes you got to chase those opportunities, particularly this time of year, because in a year where you've had a strong market, and I've seen that in our client accounts, we're all, we've got a lot of capital gains this year, and people are sort of looking, okay, if I get any losses, I can crystallize as I reduce those gains, reduce my tax bill next April. And they're putting extra pressure on these stocks. And I think that creates opportunities. So like BCE, Northland Power, Cargojet, MDA Space, ARC Resources. It's a bunch of names that I've seen have been under pressure lately that I think will relent after that. And the valuations and the stories are still good.
John, thank you very much indeed.
Andy, have a good day.
You too. John Zechner, chairman and founder of Zechner Associates.